Greetings on behalf of your financial team at Paul Reed Financial Group. I want to welcome all of you to the first in our client education series. The focus of our series, folks, is really to provide some timely information in a virtual format about the markets, about inflation, about the economy, about retirement, any planning issues. So we're pleased to present this to you. And you know, we've got 200 attendees from about 16 states. So I want to welcome all of you and appreciate your attendance very much. What I'd like to do at this point is turn everything over to our host, Tim Kimmel. He's our Chief Financial Advisor. You all know him well, and a great friend and principal of the firm. Tim?
Thank you, Paul. I appreciate it. And, you know, boy, I echo Paul's thoughts on just the welcome. I've been part of Paul Reed Financial Group for now going on 30 years come this July. And it's been quite a journey and honor, obviously, to work with a lot of you. For those of you that have not met me, I've been, like I said, a senior advisor here at the Paul Reed Financial Group for, boy, going on, like I said, 30 years. And again, it's been a pleasure, obviously, to work with all of you. And I look forward to, obviously, for those of you that I haven't met, meeting you at some point. As Paul mentioned, this series of events, this education series, has really been something that's been kind of long in our discussions, something that we wanted to unveil and roll out, and finally here it is. So we're again thrilled that you all joined us, and looking forward to again rolling these out. As I mentioned at our client event this last fall, the plan is we're going to have one of these events every quarter. There'll be different topics, different points of conversation on planning and just educational based discussions. So again, should be really informative and educational. Today, we're going to be talking about 2023 outlook and the economy, talking about topics like recession, inflation, and just the general outlook for the year. There's a lot of confusion, a lot of information out there that obviously is conflicting. So a lot of varying opinions, but obviously we're working with some of the best professionals out there in the industry. We've got 3 of those individuals joining us today, one of which is Carl Platou. He joins us from Capital Group, kind of the home of the American funds, managing some of your funds within your portfolio. And Carl is a wealth management consultant and has been in the industry for 40 years. Also with us is Casey McGowan, and he's joining us through Invesco Group. And Casey's also senior vice president with Invesco. And both of these gentlemen are high integrity, some of the best individuals that I know of in the industry, and full of insight and good content. So I think you're going to enjoy what they have to say. Also with us today is one of our own, Adam Jordan. And Adam is our director of investments and management. He's the one that does put together a lot of the allocation portfolio structure. He's the one that monitors the funds and obviously knows very well what's going on internally within those funds and the management teams. He's constantly conversing and finding information out. Not a week or two goes by that we don't have conversations with your fund management teams, and Adam's a pivotal part in that. Adam does have his SEMA license, and that's a pretty prestigious international designation, and you know, Adam's a wealth of information. Adam also, just so you know, is also available for anybody that has specific questions on a fund or an allocation question. I know that you know, Paul and myself and Kelly and James are the ones that typically meet with you, but Adam is again very pivotal in helping obviously coordinate our investment strategies and oversight, but also is available to all of you as well that have specific questions on a fund or an issue related to questions on an allocation strategy. So, you know, certainly use Adam. He's a wealth of knowledge and very articulate as well, as you'll find out from listening to him today. So, so the format today, just to lay this out, is we're going to try to respect the time frame the best we can. So we're going to be together for 50, 60 minutes. We're going to have some prepared kind of conversation just with Carl and Casey and Adam, and then we're going to open it up to questions. And the question capability of Zoom is typically there's a toolbar on the bottom that you might see, and either there's a Q&A icon, or you could click on the more icon and then get to a Q&A section. And then ultimately you can type in your question, and then we'll collect those throughout the session. And then at the last 10-15 minutes, we'll try to get to as many of those questions as we possibly can. So with that format, like I said, we're very excited to launch this education series. As Paul mentioned, again, it's part of our what I'll call peak series of services. And what that means, peak, for many of you that maybe haven't come across that, it's in our marketing material and in our information that we put out. But peak stands for P, planning. Obviously, each one of you has a specific plan that's designed around your specific goals and objectives. And that's obviously discussed and coordinated and reviewed on an ongoing basis. The E is education. That's what this series is about. And obviously everything that we do, as those of you that have known us for any length of time and have come in, is that we're very educationally focused. Our goal is to provide you information and equip you and your family to make the best decisions that you can for you. And that is all about the educational piece. And these series of conversations we're going to have throughout the year and moving forward in these quarterly events are going to be all about the education piece. The A is advice. Obviously, we're independent fiduciaries acting on your best interest and on your behalf, and obviously giving advice and recommendations and thoughts based upon your goals and objectives moving forward. And then the C, consulting. And obviously we have ongoing reviews and consult on various topics, from senior living situations to, hey, buying a house, how do we coordinate and orchestrate that, to even, hey, buying a car, should I pay cash, should I buy it on time, and other topics and conversations as well. So that's the peak process. That's our series of services that obviously we focus on. And again, this has kind of been birthed. This idea of an education series has been birthed out of that peak series of services. So with that said, we'll kind of get started. And I know you want to hear our panelists, right? And not listen to me, but I'm going to ultimately open it up, Carl, to you first. Carl, for you, I'm going to ask kind of a question that's kind of open. Take as much time as you'd like. But the question really centers around the U.S. economy. And there's a lot of talk about where the U.S. economy is going in 2023, obviously tough 2022. And the reality is that a lot of conversation about recession, right? And so, are we in a recession? Are we going into one? Have we had one? So again, would love to open it up to you just on your, Capital Group's thoughts, your thoughts, obviously, on 2023 and the U.S. economy and some of the outlook thoughts.
Perfect. Tim, can you hear me fine?
Yep.
Good. Yeah, thanks for the question. And, I've known you and Paul and the whole team now for a long time. And as you mentioned, going on close to 40 years. And I suspect there are a number of folks listening here today or watching that I may have met at one of your annual meetings. And I started to reflect a little bit on that, because if you think about it, you go back through time and there was some awful events, 2000, you think about 2001, 2002, and then 2008 and 9 with the financial crisis. And then, of course, more recently, the pandemic. And then in turn, we see the volatility in the markets. And if we held this meeting a year ago at about the same time, and you would ask that same question, we likely would have been talking about late cycle for the economy, getting closer perhaps to a recession, maybe in a year or two. Now, this would have been a year ago in February. We would have been talking about inflation heating up. We would have talked a bit about the Federal Reserve having to step up and start to increase rates. What we likely would not have been talking about is Ukraine. And because it was really this next week that thing started to really erupt, and the awful events started to cascade from there. So here we sit a year later, and of course the Federal Reserve had to raise rates quite aggressively. The impact is that bonds went down, stocks went down, And I myself, like many of you listening, I'm getting close to retirement. So my account was down, as I'm confident many of your accounts were down, and that doesn't feel good. So we start to ask the question, where do we go from here? And our sense is that inflation is going to be a little stickier than some people perhaps thought. So the Federal Reserve likely is going to raise rates here, continue here in the spring. Hopefully that'll come to an end maybe around mid-year is our sense at this point. It could be May, could be June, but somewhere around mid-year. That historically tends to be pretty good for bonds. It also tends to be pretty good for stocks. But what about the economy? Well, oftentimes the markets move before the economy actually goes into recovery. Our sense is that whether we're in a technical recession or we go into a technical recession, our sense is we will continue to see some slowing in the economy. One of our portfolio managers on a call last week said his thought was it likely is a small R, smaller recession. And like many of these, it depends on where you sit, because the jobless numbers still are quite good in terms of there are a lot of jobs out there, not that many people unemployed. In fact, historically, it's quite low. So it depends on where you sit. Yet in Seattle, we read about layoffs from Microsoft and Google and Facebook and Amazon, and the impact on some people is meaningful. It's significant. So we think likely we have some slowing, but the positive is we also expect there is a real shift in economic activity around the globe post-COVID. Many companies are shifting their manufacturing from far off distant places, China and so forth, and bringing them a little closer to home. We're finding the infrastructure is changing. You see that in terms of the electric grid in the country. We just saw this last week. Ford announced close to a $3 billion battery facility in Michigan. So we think the old economy is going to be necessary to make the new economy work. So that means steel, commodities, Caterpillar, your tractor. They're building mining equipment now. The mines are going to be really busy because we're going to need a lot of cobalt. We're going to need a lot of copper. We're going to need a lot of steel. So we're really in an interesting period of time. So let me just kind of maybe put a button on it, Tim. I think if we could stretch our time frame out for all of us, we likely see an exciting period over the next bunch of years where some of those stocks or companies that we thought perhaps weren't doing so well maybe start to prosper a little bit more. And so the economy likely has some slowing, but still pretty robust is our feeling, at least domestically.
Yeah, thank you, Carl. And kind of follow-up question to that would be, there's a lot of confusion about, the recessionary definition, right? So, kind of give our group a little bit of a definition of how you would define a recession. I know, again, it seems like the ingredients seem to obviously be changing a little bit about what that looks like. So maybe give us a little quick definition of recession and typically maybe some historical perspective of if there is one, what does that typically look like?
Yeah. So, technically, people like to refer to as two quarters of negative economic activity, but that's just a layman's quick view at the economy. There are more measures that the economists look at. Unemployment is a big one. Housing is part of it. And so it's usually multiple quarters out before looking backwards, the experts. And you know how the media often says the experts say, we just experienced a 2-quarter recession or a 3-quarter recession or something of that nature. And so, and then when you kind of think about what's that recovery look like out of the recession, you ask, if we go back through history, the really tough recessions, and I would suggest 08 and 09, that is a period of time where you saw dramatic steps by the federal government, by the Federal Reserve, moving interest rates all the way down to zero, and they stayed at zero for about 6 years. The government has some tools. Fortunately, at this stage, with rates being higher, the biggest tool we have is the Federal Reserve being able to reduce rates. So the positive, and there's a couple positives to rising rates in the last year. One, of course, is if you're a saver and you have some money at the bank, your yield has gone up. That's nice. But the other side, from an economic standpoint, and the government managing a recessionary environment, they now have the ability to start to reduce rates. And at this stage, the market is suggesting that that could actually happen later this year or maybe into next year. Our folks on a call 2 weeks ago, they think it's not real likely it happens later this year, but perhaps next year, once we perhaps see Fed fund rates top out somewhere close to 5%. But that's the biggest lever amongst some other things that the government can do in terms of managing through a recessionary environment.
Yeah. So to turn the conversation a little bit to politics. I know that's not necessarily a pleasant conversation always, but there's a lot of talk about the kind of debt ceiling and the debate, obviously, looming regarding that. Carl, how do you see that factoring in? Do you feel like there's a real threat of the government not finding some common ground? I mean, what does Capital Group say about the debt ceiling and how that could impact the economy and the outlook and all that?
Yeah. Didn't we talk about it? We can't talk about politics on it.
Yeah, that's right.
I'm going to pass that question, I think, to Casey. So, hey, in seriousness, we have a monthly call with our folks out of our Washington, D.C. office, and this is going back to January. Their sense is there's a lot of politics being played. Of course, we have the House being run by the Republicans now, the Senate run by the Democrats, and obviously a Democratic president. So the Republicans are going to use this negotiation around debt ceiling to get some, hopefully some consideration for thinking about the budget on an ongoing basis in a practical way. And I don't want to put politics out there too far, but the debt ceiling likely gets raised is what last I heard on our call, but it won't be without some negotiation on both sides. And as one of our folks said, and this was on a call back in the fall, she said, be careful watching the news because there's a lot more going on the ground in Washington, D.C. than what you see on the news. And I suspect many of us who are listening today have kind of realized that over the years, but she is intimately involved. She speaks with senators and congressmen on a regular basis. But I think her point's well taken, that there's a lot of negotiation going on right now, and what is getting played out in the media is probably not what the real negotiations are all about.
Yeah, that's great. Well, let's turn our attention to the international markets a little bit. So I'm going to pull KC into the conversation now. And so give me, Invesco's outlook for 2023 and in the international side of things, and any opportunities or issues that you see on that side of the equation.
Yeah, thanks, Tim and Paul, Adam, and team. And as Carl mentioned, I can't see everybody, but I'm sure I've met many of you over the years. So thanks for allowing us to have time with you today. It's always good to catch up at the first of the year, especially when the results have been a little bit better year to date than we finished up with last year. But to save a little bit of time, I would say that our outlook as a whole, and I know Carl talked mostly domestically, would be somewhat the same. And you asked me to touch a little bit, just on the inflation part, which I'll expand on. But there was the good news, bad news yesterday. Year over year, inflation was down to roughly 6.4, and everybody feels like we're heading in the right direction. And I think most of our analysts feel that way also. But there was also the month over month core inflation was up about 0.5%, which is obviously ex food and food and energy. So the indexes and what are tracked are a little bit you have to be pretty adept of looking at them and knowing what they contain. But I think overall, the thought process was the news continues to be better. Rates are having an impact. One of the things that, Carl pointed out, but didn't elaborate on is rates did and have gone up pretty much faster than they have in history. And there's kind of a 9-month build in to see what that rate effect actually is. So nobody really knows yet what the impact of those are. But we would suspect, as Carl mentioned, there's probably a couple more. I heard some people this morning saying, maybe at the outside 3. But that leads us to, the recession. Are we going to go into one or not? And I talked to an analyst yesterday, and he said, well, maybe the best way for people to start thinking about this is the hard landing, soft landing is maybe there's really kind of no landing. It drags out, there's growth, rates have an impact, maybe in the rear view, we were in recession, a small R, as Carl mentioned, a little bit for a period of time, but I think forward looking is really where we want to be, and that's going to kind of take care of itself, the backwards looking news of what happened. So, from that perspective, Tim, as it relates to the international markets, a couple things that we would say, having been through these calls for 20 plus years with you guys too, is one thing that people haven't thought about, other than they didn't want to own anything internationally for the last decade because they didn't see the return profile that they saw domestically, is that clearly left valuations significantly lower on a lot of international stocks around the world than the domestic stocks, right? So that's been a super positive. In many places, they're half of what their historical norms are. So, I know clients come in and ask Adam and you, that's fine. They're cheap for a reason. They're not very good. They're in bad places. And that in fact isn't clearly always the case. But to elaborate a little bit further, obviously the China reopening, has been good for Chinese stocks, emerging market stocks, I think good for production and inventory news around the world. The other thing that comes into play there is as rates get closer to the top, obviously the dollar gets to kind of a high, which it has been in late last year, late October, we started to see the dollar start to weaken against emerging market currency and some of the euro and international currencies as well. So what a lot of people on this call probably don't know, because they don't live in the world we do, is international equity flows have been much better over the last couple months than even domestic equity flows have been, in part because the dollar weakens and makes them more attractive, and the valuation play of these stocks being significantly more attractive. So for those of you that have been on these calls for years, I kind of hearken back to the 02 through 06 period where we started to come out of the dot-com wreck. Rates were, going up. They kind of came to a top. The market, the S&P did well, but international and emerging markets did significantly better from that point because the dollar weakened a little bit and valuations were better. So in that, no landing environment, maybe where we're closer to the bottom than just entering it, and maybe even more so in other places of the world. We know you guys are good allocators, but there's a lot of people, because there's been not good returns for the last decade, have kind of written off the international part of the markets. And we certainly would think that that's probably not a great idea at this point in time, that valuations, the dollar, China restarting, things heading more in a positive direction means that those need to be meaningful parts of a portfolio.
That's great. And KC too, one follow-up question for you would be, what, as far as the strength of the dollar last year, what were drivers of that, and what do you see changing this year, out of curiosity?
Yeah, well, the dollar strength in a lot of cases comes from the rate at which interest rates go up, right? Where's the safe haven? Where do people want to go? Where do they feel comfortable? Where can they get more on, as Carl said, their money market or treasuries, et cetera? And if we're raising rates and we're on the front of that curve, the dollar naturally gets stronger because of that. As we start to get to a point where maybe there's another 25, maybe there's 50. If you talk to a lot of people on the street, they're like, oh, the Fed's not going to be able to hold for very long, and then they're going to have to start lowering rates. Those become very attractive components for borrowing in other currencies and other countries. So the peaking of rates rising certainly will help. And as you asked last year, why did it get stronger? Obviously, the rate hikes that we've seen and the magnitude that we saw, rushed the dollar up pretty quickly.
Very good. Well, thank you, Casey and Carl. Great comments and thoughts. Now I'd like to pull Adam into our conversation, and Adam, obviously, as a director of investments and oversight of client portfolios here, and obviously being a pivotal liaison, obviously, between the funds and the management teams, and obviously our clients. Any comments on outlook for 2023 and some of the thoughts of Carl and Casey shared?
I think kind of pointing out, going back to kind of what Carl started with was the rough 2022, and just to put that in some context, to elaborate on the context. Actually, if you look at bonds going back 100 years, bonds just experienced their worst calendar year period ever over that time frame. So people are used to experiencing drawdowns in stocks, but not usually simultaneously or even at all on the bond side, those sorts of losses in bonds. And at the same time, we had stocks experience their 7th worst calendar year ever. Now, again, that's calendar year. There had been times like intra year where you experienced larger losses in stocks. Like, for instance, think about the COVID period, 2020. Year ended up, but remember, there was a drawdown of 34% losses in the S&P 500 there. So you take the worst calendar year ever for bonds, the 7th worst calendar year for stocks, and then you look at that in a portfolio context of 60% stocks, 40% bonds, and that actually turns out on a calendar year basis to be the 3rd worst return for a 60-40 portfolio. And actually, the only periods worse than that were in the 2 years in the 1930s. Again, those are calendar year periods. 2008, we a 60-40 static 60-40 portfolio I'm talking about here, just index based, experienced a worse drawdown in 2008, but again, not necessarily on a calendar year basis. So definitely, it was a tough environment. Anywhere you were looking to invest. So, and as we look forward, rather than being more subdued about that, it should raise our confidence going forward, especially, I think, in the bond area. We've gone from, ever since kind of the financial crisis, we experienced, ultra low rates, essentially earning nothing in your bank account. Whereas now you can actually get, reasonable yields in earnings kind of on a risk-free basis on your high yield savings, high quality bonds in your portfolios. So we're seeing opportunities in that regard, rather than being discouraged from the last year. It gives you some encouragement, that you can, on some of your safer assets, you can actually get some earnings there. And as Carl was talking about, recession, no recession, how are we looking at that? I think it's important to also realize, economic recessions versus kind of earnings recessions. There are 2 different things. And we didn't have an economic recession last year. Yeah, we had the 2 negative quarters of GDP, but as Carl talked about, very strong job growth. In fact, every 3-month period last year was stronger employment growth than any 3-month period during the whole recovery from the financial crisis to the COVID experience. So we never had a 3 in every period. So it was strong throughout the year, and that continues the last 3 months. Obviously, that can change. We've heard about the announcements and layoffs. And those have been announced, but they haven't been implemented yet. So those will probably roll into the numbers that we start hearing about, the employment figures in the months ahead. But more importantly, I think it's the earnings recession that markets care more about. Obviously, they're usually correlated with one another, but not always. But we started the earnings recession last year. So we're in an earnings recession. The earnings kind of bottomed out in the summer of last year. and have come up a little bit, but I think, you know, we should be prepared for more headwinds on the earning front. So maybe, you know, economic recession is probably maybe not 2 negative quarters of GDP. Maybe we get a recession like 2001, where we only had 1 negative quarter of negative GDP. But the earnings, all those other factors that go into determining recessions, is what determined the 2001 recession. It was the job losses and those sorts of things. So I think we could have a scenario where we have those factors driving the call of a recession rather than GDP figures. But again, it's the earnings recession that the markets care about. And so I think that's what they're going to be grappling with, you know, as kind of the year unfolds.
Yeah. So another question would be to you, Adam, is that, well, given all the elements obviously within the economy globally, obviously, domestically and internationally, how do you see that factoring into portfolios for our clients? And obviously, are there opportunities in essence that you're looking to take advantage of? And how does that get integrated into our strategies?
Yeah, I think it just kind of goes to Casey's comments on international. I really think international is giving a lot of opportunities. You know, it's been very out of favor for the last 10 years. But again, you want to bring it back in historical context and look at, like, you know, the decades 2000 to 2010 versus 2010 to 2020. Those were kind of mirror images of where you wanted to be. And I think that could play ahead for the next 10 years. And in 2010, you know, the S&P 500 lost you cumulatively 9% over that period. Whereas international, again, historically subdued returns, but positive returns that got you over 30%. And bonds over that period got you, you know, over 80%. So again, it's diversification. And bonds are, again, looking much more attractive now than they have probably the last 10 years. So we're liking, you know, in the portfolios, we're liking the opportunities in the bond area. Kind of that foundation area is actually giving you stability plus return now versus just stability. And so again, it's the bonds of the area, international, especially because of the, you know, the currency exposure there. We think, you know, the dollar has been very strong, but that's because we have been raising rates faster than the rest of the world. So that's really, you know, strengthened the dollar. But as we, you know, start slowing down the hikes of our interest rates, I think that should subdue the, you know, the interest in the dollar. And so it's bonds, it's international. And I think the market overall is downplaying inflation a little bit. You know, they were thinking that we can easily get this under control, but the markets are only pricing in about 2.5% inflation over the next 5 years. If you think it's going to be higher than that, then that's why it's important to continue to have, you know, inflation hedged assets in there, things that can benefit from a continued inflationary environment. So that's kind of how we're looking at it as far as it relates to client portfolios.
Yeah, and Adam, a couple more questions for you. So, you know, interest rate, you mentioned interest rates and obviously maybe some opportunities within bonds. I mean, where do you see the Federal Reserve going moving forward? Do you see them continuing to raise rates, obviously trying to kind of stamp on the inflationary the inflationary pressure, or do you feel like, hey, we're getting closer to a pause, and again, the implications that has in the bond market and also on the general market, equity markets as well? You know, how do you see that?
Yeah, it's you know, always tough to call what the Fed's going to do, but they are trying to be pretty transparent about it. Obviously, we've seen them, you know, reverse course many times before when they say what they're going to do. But looking at you know, just the outlook, the employment situation, the markets want them, I think, are expecting them to reverse course much quicker than I think they will reverse course. So we're definitely going to see it, you know, Fed funds rate go to 5, you know, maybe 5.25. And then maybe they slow down and pause. But I think they will be very hesitant to reverse course. I think that will kind of hurt their credibility. And plus there's nothing yet in the economic numbers that should really tell them to reverse course too much. Employment, again, like I said, stronger than it was at any time during the last expansion. You have a lot of, especially in the inflation numbers, while goods inflation has kind of started slowing down a little bit, all of the services inflation, so things like wages and things like that that are feeding into that, are really the part that sticks around. And those are the parts that the Federal Reserve should be worried about, because those are the least likely, to abate. And so I think those are going to keep inflation higher. And so I don't see them, unless something severe happens, I see them trying to stick to their guns at least throughout the year.
Yeah. So would you say kind of higher for longer, kind of this mentality versus this expectation of lowering rates maybe later, later in the fourth quarter or, earlier, would you say?
Yeah, exactly. And for people's, safer money, that's a good thing. You can earn more on that shorter term, safe money.
Great. Excellent. Very good. One other question, Adam, just again, final one for you, and then we'll open it up for Q&A questions. So again, if you have any questions, go ahead and type that into our Zoom platform here, and we'll be sure to try to answer as many of those as we can get to. So last one, Adam, for you would be this concept of activity versus management, right? I mean, as we've talked to clients many times, is that, we'll make fine-tuning adjustments and what I'll call tweaks, but we generally steer away from these extreme, extreme moves, right? These big in and out kind of things, or radical shifts, right? We'll make, again, course adjustments and rebalance the portfolio, but how would you respond to that idea of, hey, activity versus management, and how do you see that obviously playing into portfolios as far as what we do internally?
Yeah, well, I think it kind of speaks to the reason why we're using active management, why we find teams that are active managers, so that we can work with the client to build kind of their strategic allocation that we know is going to get them where they need to go, for their retirement goals or other possibilities. But with the active management, it's not like it's different than building it with indexes, where to make a move, you need to see it on your statement of buying one index fund and buying, US index fund to buy international index fund or something like that. When we're working with active managers, that we are giving the flexibility to own international or own US, or the flexibility to own different types of bonds. While you may see on your statement, those 10 to 12 different funds, and you may not even see, one switch out during the year. That doesn't mean there's not a lot of activity going on behind the scenes, which is within the funds. If you were to kind of look through those individual funds and see what they held, what individual stocks they held, or what bonds they held, there would be a lot more activity. And actually, if you were getting a confirmation on every time you saw something changing within those funds, you'd be overwhelmed kind of with the amount of things going on behind the scenes. So while you might not see it on your statement, there are wide swings, especially in kind of our dynamic alternative area, where we're giving those. That's where we give the managers the biggest flexibility on the asset types that they own. International versus domestic, the types of bonds they own. A lot of adjustments that are going on in there. If you look at the start of last year, what they owned, to the end of this year, you would see a lot of different allocation shifts. So there are allocation shifts. Again, we're not letting the managers go anywhere all the time with all the managers, because we need to keep the portfolios within a structure that we know is going to get you where you need to go, but while still allowing them to take advantage of the short-term opportunities that the market provides intramonth.
That's great. Yeah, great. Excellent. So thank you, everybody, obviously, for your thoughts and comments. Now we're going to move into our our kind of Q&A section of our time today, and I've got a few questions kind of coming in. First question, Carl, would be for you. I mean, Capital Group, obviously the focus of, obviously for you today is on the US side of things. So again, talk to Adam a little bit about interest rate cycles and Fed policy, but how do you see interest rates factoring in for the remainder of the year? And do you feel like, again, this higher for longer concept, is that something that seems to be fairly prevailing within the industry, but is that kind of Capital Group's view as well?
Yeah, as far as the Fed, this is one of those years where there are a number of scenarios that could happen. Let's just say there is a peace accord in, the awful war in Ukraine in the next month or two. Well, that of course would have a positive impact on not just a bunch of individuals' lives, but it would probably have a positive impact on oil prices. They would probably come down. And that likely means inflation would come down a little faster. And then in turn, the Fed would perhaps not have to raise rates quite as much. Maybe they stop in March. So there's a scenario there where, okay, that could all be pretty positive. That likely would benefit investors on both the bond side and the stock side, and results could be fairly robust. But what's the likelihood of that? Our folks don't think that's real likely. Things may get more difficult in Ukraine than better in the short term, unfortunately. So on the other side, if, Casey touched on this a little bit with, you kind of think about the global marketplace and the impact of inflation, not just here, but internationally, and then you have the dollar. So our base case is we do think the Fed is going to have to be somewhat aggressive, meaning raising rates, and Adam touched on this, perhaps in the mid-year. Inflation's a little stickier. We don't think it's coming down quite as fast as some people have expected. And, we see it. We go to the grocery store, all of us, and you see the prices and you think, oh my gosh. And then you put gas in your car. So until those start to come down to the 4% inflation number, 4.5, we think the Fed is going to be a bit more robust with their interest rates. So, but the positive is historically, going back the last 50 years to the 70s, and many of us remember the 80s and the 90s, the Federal Reserve has had to raise rates 8 times. We've been through these cycles 8 times. Well, that first year, once the Federal Reserve is done raising rates, they say, that's it. We got to the numbers we like, inflation settled down, and the following year has been pretty positive for bonds. If you look at investment grade, high quality bonds, government bonds, it's averaged just over 13%, with the lowest at 6.5%. So we're not suggesting that the next 12 months will be absolutely robust in bonds, but it would not surprise us. And in turn, that also tends to be fairly positive for stocks. So, there's a lot of scenarios that could play out, and this is a typical of these outlook kind of calls. It's a little bit like forecasting. What do you think summer will look like around Puget Sound? Is it going to be really hot, or is it going to be wet? We don't know. We'll find out. But at this stage, our base case is likely the Fed will raise rates 2 or 3 more times, maybe a fourth, but not likely, and that we stop somewhere around mid-year. And if that happens, depending, as Adam said, it's all about earnings. So if companies, we can identify those companies that have the ability to accelerate their earnings, continue to grow their earnings, could be a reasonable outcome for investors in the following 12 months.
Yeah. One more follow-up. I'm getting some questions on employment and the employment picture being pretty strong. Carl, what do you attribute that to in the United States in particular? Is that kind of a fallout of the pandemic, obviously, and companies outside of technology still looking for people? Or, I mean, what the 511,000 jobs a few weeks ago, pretty strong. What does Capital Group, how does it view that in light of some of these outlooks?
Yeah, it's a bit of a head scratcher because we all see the signs. In fact, I was at the grocery store yesterday locally. Of course, it was Valentine's Day, and the fish counter was closed. This is a robust grocery store, and the sign said, due to staffing problems, no fish. And that's a very small case, but we see that. All of us see it in all sorts of different venues where people have staffing issues. They just cannot get enough people. And oftentimes that's in the retail capacity. We do think the shift in the economy, the capital spending for many companies is going up. I talked about battery factories. There are new pharmaceutical manufacturing facilities. There is an entire grid to electrify cars in this country that's getting built out. We have pipelines that are getting put in the ground. There's an awful lot of work that's going to be done in the next 3 to 5 years. And I didn't even touch on the infrastructure bill and the money that's coming from that. And we're going to need a lot of bodies. And those bodies aren't necessarily the ones that we see at retail stores or restaurants, but we're going to need people who are skilled in crafts, welding, carpentry, plumbing, all sorts of metals. So I think our folks think it's going to be a fairly robust environment, but COVID caused some fundamental shifts, and the restaurant industry is feeling a lot of that pressure. The retail industry is feeling a lot of that pressure, and that doesn't get fixed overnight. But we do think the jobs, like you said it, notwithstanding technology, Microsoft's still strong. Amazon's going to remain strong. So will Google. They just simply are being practical about the environment and saying, we think we're in an economic slowing period, so we may have overhired a bit, and they're skinning that back.
That's great. Casey, a few questions coming in for you as well. So kind of the one question from Andrew is about the correlation between US dollar and strength internationally or weakness internationally, and the maybe transition with that, and the idea or concept of maybe trying to not, time or coordinate, obviously, an additional allocation internationally to when the time is right. I mean, how would you approach that question with regards to kind of timing getting into the international markets based upon certain, outlook or prognostications that, what are your thoughts or comments on that?
Yeah, well, I think it can be kind of like the domestic conversation a little bit. Every country is a little bit, different in their own economic cycle and what's happening, but there are many, best in class companies around the world that can benefit from, dollar trade, where they sell their goods, etc. So, our feeling is that as it relates, I guess, to the dollar and our clients and domestic clients, if you will, looking to invest and time it, if you will, a little bit. Part of that would be they should always own it, or a piece of it. The question is, how much or are they potentially increasing it? And I think just like the US, and Carl was just talking about this, where the Apples and the Microsofts, et cetera, are laying off because they overhired. The real issue becomes then if rates stay long for a longer period of time, it really strangles the growth prospect of the mid and small cap companies a little bit. And then that becomes kind of the issue, right? The many smaller local merchants or mid-sized companies have some issues. And where I was going with that is when rates start to come down or the dollar swings internationally, or we call it the flywheel effect in emerging markets, when borrowing becomes cheaper, which it is, and there's more demand for goods and services, and they can make them at a lower price. To Carl's point very early is jobs are coming back domestically, but wages are going up, and nobody wants to go to the store and pay $99 for a desk clock when they can buy it from China for 15, right? And so that demand will continue to be there, which will drive those companies when their valuations are low and they can get money. Their earnings will go up. When their multiples are low, those look very, very different from the companies we might be looking at domestically that are high. So it's a little bit of a one versus the other, but the opportunity is always a little bit before we think it is, which might have been when we saw quote unquote smart money start coming in at the end of last year when everything looked, not very good.
Yeah, it's good to kind of suggest too, or at least be aware that the data is always backward looking at telling us what's already occurred, and we can draw conclusions from that information. However, the market is forward pricing, right? So again, the idea of maybe timing our entry points into various opportunities is always a bit difficult, because again, once we start to feel like, yeah, this is the place to be, oftentimes the markets have already, moved well ahead of that. So again, like you said, good to have obviously a dedicated allocation all the time, because again, you just don't know how, how quickly the markets can change is sometimes like head spinning, right? I mean, we saw that pretty significant move internationally late last year, to your point. And and so that idea of timing is always nice in theory, but very difficult, because oftentimes we wait for confirmation and the information to suggest, yeah, that's the place we want to be. And it's oftentimes already, after the fact kind of thing. So
I think there's one other
go ahead.
point there, Tim, is that, Adam does a good job of looking at portfolios as you guys do. And sometimes, the international mid-cap companies, we could name a lot of them, but they may do most of their business within the domestic, a European mid-cap company may do most of their business within Europe. And if Europe is growing and they're buying it, we still get the benefit of a weakening dollar, but we don't have to worry about whether they can sell that same good in China or Australia or somewhere else, right? So there's many different ways to play this. And obviously people know if people don't really like that, I'm sure Adam's got a lot of ideas that, hedge the dollar and make it not an issue. So the good thing is there's lots of tools to use, I guess.
Yeah. Another quick question, Casey, and, we're kind of going to be sensitive to time, but I've got 3 questions, obviously, that have come in for more on Adam's side, but one more question, Casey, for you would be, obviously any areas internationally, Kathy's asking any question or any international areas that you would suggest avoiding. I mean, obviously, with all the geopolitical issues going on in Russia, Ukraine, and China, policies, obviously with COVID and supply issues, is there any area that you would be particularly leery of internationally at this point?
Yeah, I think there's the sensitivity to obviously, areas of political risk, war, etc. But I would be careful to say a little bit, companies don't know where they're supposed to live. So there's great companies in a lot of different places that just happen to have a great idea. And it's probably more important in the end that we buy those great companies than we worry about exactly where they're where they're domiciled at the end of the day. If you give us a 10-year run, buy the right companies. Where they're domiciled isn't their choice, I guess, is a good way to say it.
Yeah, great point. All right, Adam, the last kind of 3, then we'll kind of have some closing comments here. But one question would be kind of related to international markets, but more kind of in the context of this idea of after COVID and the supply chain issues, this idea of onshoring, right? So Matthew asks, why should we consider international companies if U.S. companies are trying to bring those manufacturing capabilities back to the U.S.? What are your, Adam, I guess your thoughts on that, and again, how that factors into what we're trying to do in portfolios?
Yeah, I think that, that theme will, I think, play out over time. And I think that is another reason to worry about, inflation here longer, because, as more reshoring happens and we try and get away from China in certain areas or reduce our exposure, and not getting away from them, they're always going to be the integral player there. But I think, that's going to play into structurally higher inflation because it's going to increase our goods cost. But as far as, why not invest in international? Well, we also need to realize international companies also build jobs here in the US, like we know with all the car manufacturers and things like that. So while we're bringing some, manufacturing back on, that doesn't mean that international companies aren't continuing to also build jobs here as well. So, but that's also just kind of more of a, social look at it. But from another aspect, we are investing to ultimately provide returns to investors. And if, whether or not that company is, reshoring manufacturing or building manufacturing, continuing to have their supply chain internationally, it's looking at, how much are we paying per dollar of earnings that company is generating, because ultimately that's what matters to our end returns. So we're on 2 ways to look at. One, as far as the social aspect, international companies build, jobs here. And it will be good though to make our companies more robust that we're doing this. I think that's a good thing. And it will present some investment opportunities, but we also need to look at, even if a company does no business here and makes all their goods in Europe and sells all their goods in Europe, it might still be a good business to invest in. So that's kind of the way I would look at the international space.
Yeah. Another question came in as far as the, generally more optimistic or positive employment numbers and economic data. I mean, the old saying is numbers can say whatever you want them to say, right? So I guess the question underlying is, are the jobs numbers really as strong as they indicate, or is it just us getting back to where we were pre-COVID? Or, how do you see information these days, and where are we, if you will, on that scale? We're pre-COVID, not that we're completely out of COVID, but things are a little bit getting back to some new normal. Are the numbers really that much improved, or again, how do you see that at the moment?
Is that one for me?
Yeah, Adam, for you.
Yeah. Well, I do think the jobs numbers are they exactly as strong as they appear to be? Always up for debate. How many people are in the labor force versus out of the labor force, those sorts of things. Those go more into the unemployment rate though, rather than the number of jobs being added. And so I do think the jobs are strong, and even anecdotally, you can see it almost everywhere you go, especially in service sort of sectors. We're hiring now, so that the number of job openings are real. And you can, that's another number that's, while employment numbers are tracked one way, the number of job openings are tracked another way. And you wouldn't have this number of unfilled job openings if the employment picture wasn't, if it wasn't hard to get new people. So I do think the numbers are currently strong, but you are seeing signs of some weakness there that might not yet be showing up because they've announced layoffs that haven't yet happened yet. So maybe ask that question in 3 months and we might be, looking at, lower, job numbers and weaker job numbers.
Yeah. Yeah. One last question from Chris. Adam, for you. I'll focus on you, I guess. So the reality of information, right? There's so much information coming at us, obviously social media, obviously the information highway there. But the point is that, there's a lot of false information, right? And the reality is, how do you differentiate between information that's maybe not false economically? And so in other words, where do you get where is there good sources to get information, or is there one better than another, or is it a culmination of multiple sources that we as a firm kind of gather information from? So where do we get our information from as a firm? How do we go about making economic and financial decisions on behalf of clients' portfolios? How would you respond to that question?
Yeah, well, I think when it comes to getting information, I think it's, cast your net as wide as possible. And it's not that, we avoid your regular, news sources of CNBC or Bloomberg or anything. It's actually, good to see what everyone else is listening to and putting that in context with other information. And I don't necessarily think you're always being fed wrong information, on those kind of main sources. I think you're getting fed filtered information that has an objective, which is to get ratings, which might sensationalize. So they're giving you information, but it's leaned to the sensational aspect of it, because that's, part of their goal is to get ratings and high emotion and things that, of that sort get ratings. So I don't necessarily think you're always being fed wrong information. You're just slanted information, which is why, we get it from all sorts of sources, whether it's the fund groups themselves that are doing deep dive research in different aspects of the economy, whether that's Capital Group, Invesco, all the different fund groups. They're also doing deep dive research on the economy, on individual companies, seeing how those economic numbers are affecting the companies that they're looking at. So again, it's just kind of, putting your net as wide as possible, but not saying that we're not also looking at the major media sources to see what's being, portrayed in that respect as well.
Yeah, that's great. Great points. And thank you, everybody. Thanks, Carl. Thanks, Casey. And thanks, Adam, obviously, for all your insight and your perspective. We really appreciate, again, all of you and your time, obviously, today, and valuable. So thank you so much. And again, ultimately, there's a lot of information, folks, coming our way always. Information, obviously, that we get from informational sources like the internet and the news and the magazines and friends and family that have strong opinions. We get bombarded by economic data. There's a lot of information out there. And the reality, I guess, what it comes down to it on our perspective is we want you to be aware, each of you, right, have a well-designed plan tailored to your specific goals and objectives. That's, again, designed to accomplish your goals with an allocation in mind, relative to your risk return profile. Three real solid pillars I've been sharing with folks that we focus here on a firm level is one, having a high degree of liquidity and flexibility within our portfolios. Second, obviously, fiduciary responsibility to manage risk. We can't eliminate risk, but we can certainly do our best to manage that risk through a diversified and well-orchestrated strategy. And then third is obviously we want to be fully engaged in the investment strategy to participate in that upside when that upside does come. Unfortunately, what we can't tell you is where the lows of the market ultimately are, but we can tell you that with any time horizon, the reality is that good assets go down too, but they don't stay down indefinitely. And so we want to make sure that we're postured and positioned with some of the best firms available to us, and Capital Group and Invesco, just two of those groups, right, amongst many others that we're constantly conversing and talking with, and obviously gathering information and gleaning from their sources, obviously, of kind of how we should be allocating and positioning portfolios, again, but focused on your goals and objectives, not on an emotion or a feeling. And that's always sometimes easier said than done because we're all emotionally created. But the point of the matter is that, we have a high degree of liquidity, flexibility. Obviously, we're trying to continue to manage and mitigate risk. We don't know what's around the corner. That's what diversification does. And then the third piece, right, is to be positioned the best we can and allow our money management teams and Adam to do what they do best, which is to take advantage of the emotion and accumulate great companies at discounted prices. And that may not, again, produce immediate benefit, 3-6 months down the road. But generally, like I said, with any length of time of a time horizon, a year, 2, 3, that generally does produce some level of reward. And so again, we don't take your confidence and trust lightly. We value the role that you trust us as being stewards of the dollars that you trust us with. And obviously, these educational series of events are, again, a part of that. And a part of our peak extension of services that we're going to continue to roll out. Very excited to announce that our next event, so mark on your calendars, our next event is going to be May 16th, coming up here at 10:30. So we're going to have these generally mid to late morning. Looking at a couple of possibilities, it looks like our next event, again, we've got the speaker, just need to confirm that they're going to be available for our date, but his name's Max McQuiston. And obviously he's going to be focusing on a topic that's going to be very pivotal for all of our clients. It's Social Security. So if you're currently already collecting Social Security, there has been a lot of talk politically about what does that Social Security system look like. There's talk about changes within the Social Security system itself. And, we'll talk about the implications and ramifications of what that might be politically and possibilities of changes for those folks that are already collecting their benefit. Also, this health and viability of Social Security long-term, and what does that look like? And what are some changes and adjustments that can be made to make sure that that's sustainable? For those of you that aren't collecting your Social Security benefit, the conversation is going to be on, naturally, do we take it early or do we delay, get till full retirement or beyond? So all very good topic points, right? That's going to be more centralized around our next event. Again, May 16th at 10:30. So mark that on your calendars. And this too, these type of events will be are obviously recorded, and we're going to post that to our website. So be sure to share it with family and friends. This is really meant to be shared, and like I said, really information and education is preeminent in what we try to accomplish here. So thank you so much for your time, and thank you for taking an hour of your day with us. Again, I want to thank Carl and Casey and Adam, and again, all your thoughts. And for all of you, have a wonderful rest of your day. And if any questions come up, obviously, don't hesitate to reach out and talk to our firm. And we're again, always here to help and answer any questions. So again, everybody, thank you so much for your time, and looking forward to rolling these out in the future. And again, save the date, May 16th at 10:30, coming up this next quarter. And we'll firmly announce the agenda and send out invitations probably about a month before. So again, looking forward to next time, and thank you so much again for your attendance. Take care.